This indicator has accurately predicted every major recession for the last 50 years, and the warning signs are flashing red again. Now, the question is, are you going to ignore them? Because today, we're diving into the most reliable crystal ball we have. Let's get to it.
Investors waking up this morning to a recession warning from the bond markets.
The Dow plunging more than 800 points, sparked by a key economic indicator faltering.
A brutal day on Wall Street, stocks plunging as the yield curve inverted, sparking fears that a recession could be on its way.
The reason why we watch the yield curve so closely is that it has been an incredibly accurate predictor of recessions. Every time that yield curve has inverted, the economy eventually has gone into a recession.
So if you ever wondered how professional investors, economists, or even the Federal Reserve itself anticipates downturns, it all starts here, with the yield curve, specifically the spread between the 10-year and the 2-year Treasury. Now, here's how it works. Normally, long-term bonds like the 10-year pay a higher yield than short-term bonds like the 2-year. Because if you're going to lend money for a decade, you want more return than if you lend for just 2 years. But when the economy looks shaky, something strange happens. Investors rush into long-term treasuries for safety, driving those yields down. And at the same time, if the Federal Reserve is raising interest rates to fight inflation, short-term yields rise. The result? Short-term bonds start paying more than long-term bonds, and that's called an inversion. And historically, when that inversion happens, recession follows. Nearly every single US recession since the 1970s was accurately predicted by a yield curve inversion. Now, the bond market has quietly outperformed the stock market, the housing markets, and even the so-called expert forecasts at predicting recessions. And today, it's sounding the alarm again. But here's the thing. The yield curve isn't the only warning sign that's flashing. Take a look at the most recent jobs data. For months, the labor market was the one bright spot. Strong payroll reports, historically low unemployment, steady wage growth. But now, the cracks are showing. Job openings have been trending lower, the quit rate, which measures worker confidence, is falling, and just this past month, the unemployment rate ticked higher, while job creation came in below expectations. Layoffs in key industries like technology, finance, and even manufacturing are quietly raising, and wage growth is cooling, which means consumer spending, the backbone of the US economy, is under pressure. And a weakening labor market combined with an inverted yield curve is a dangerous mix. And historically, when unemployment begins to rise after a yield curve inversion, that's when a recession officially takes hold. And guess what? That's exactly where we are right now. Now, let's take a walk through history. Using the Federal Reserve's own economic database, the FRED system, on this chart, you'll see three things: the 10-year minus 2-year Treasury spread, the effective federal funds rate, and the shaded gray bars showing US recessions. Now, watch what happens. Every single time the yield curve dips below zero, a recession follows. Not instantly, but within months. In the early 2000s, during the dot-com bubble, the bond yields inverted, they uninverted, the Fed cut rates, and then a recession followed. During the Great Financial Crisis, the bond yields inverted, they uninverted, and the Fed slashed rates as a recession followed. Now, during the COVID crash, the bond yields inverted, they uninverted, the Fed cut rates to zero, and guess what happened? Another recession. And now, today, the bond yields inverted deeply in 2022. They've since uninverted, the Fed has already started cutting rates, and according to the CME Fed Watch tool, is scheduled to continue cutting rates at its next meeting in September. And that's not just speculation, that's data. Now, here's where it all ties together. When the yield curve inverts, then uninverts, and the Fed begins cutting rates, that's the moment history says recessions become inevitable. That exact sequence happened before the dot-com crash, before the 2008 Great Financial Crisis, the 2020 recession, and it's happening again right now. So while the headlines may say soft landing, and Wall Street tries to pump optimism, and politicians talk about a resilient economy, the bond market is quietly whispering the same warning it always has: recession first, recovery later. But here's where it gets interesting, because not all recessions look the same. The dot-com crash destroyed technology stocks, but barely touched housing. The 2008 Great Financial Crisis destroyed housing and banking, and COVID shut down the entire economy in an instant. So what will this next one look like? Could it be commercial real estate already under pressure from remote work and high vacancies? Could it be the stock market inflated by years of cheap money and speculation? Could Could it be the government debt itself, as deficits and interest costs spiral out of control? Now, we can't know exactly, but studying the data, the jobs report, unemployment claims, housing data, and the bond market have always whispered the truth before anyone else admits it. And remember, while recessions bring pain, they also create some of the greatest wealth-building opportunities of all time. Investors who positioned themselves correctly after 2001, 2008, and after 2020 walked away with life-changing gains. Now, let me ask you, do you think the next recession will look more like 2001, 2008, or 2020? I'm curious what you think. So, for many of you watching right now, if you're in your 50s, 60s, or already retired, you're not just watching the stock tickers, you're watching your retirement accounts, your pension income, and your home's equity. And that's why this matters more than ever, because understanding cycles isn't optional, it's critical. And if you're prepared, you can protect yourself and even take advantage of opportunities when others panic. And if you ignore it, you risk being blindsided. So here's the bottom line. The bond market has been the single most reliable recession predictor for more than 50 years, and it's flashing red all over again. Now, history doesn't repeat exactly, but it does rhyme. And right now, every rhyme points to the same conclusion: recession first, but recovery later. And the question is, are you going to be ready for it? Now, if you found this video helpful, hit the like button, subscribe for more financial breakdowns, and share this with someone who needs to hear it. Thanks for watching, and I'll see you on the next one.